All right, ready to dive into something different.
Oh, yeah.
We're talking profiting during recessions.
During recessions.
Yeah, you heard that right.
Mm.
Usually people want to hide their money when they hear recession.
Right.
But not this guy.
Yeah.
This financial expert we're looking at today, he gets excited when the economy takes a downturn.
Interesting.
It's pretty wild. And we're working with just one source for this deep dive, just one YouTube video where he lays out this whole strategy.
Okay.
So think about it for a second.
Yeah.
How do you feel when you hear recession?
A little nervous for sure.
Yeah.
A bit terrified even.
Yeah.
Haha.
This guy's over here doing a happy dance.
Wow.
Okay.
Let's find out why.
Yeah, let's find out. So what makes him so excited about recessions?
Well, what's so interesting about his perspective is that he views recessions as like this natural cleansing process for the economy.
The cleansing process.
Yeah, he even compares it to a forest fire.
Whoa. Okay, I'm intrigued. I got to hear more about this forest fire analogy. So he argues that just like a fire clears out all the dead wood
Right.
and then makes way for new growth, recessions essentially eliminate weaker companies.
Oh, I see. Survival of the fittest.
Exactly.
So the companies that can't handle a recession, they just kind of get wiped out.
Yeah, he calls them the crap companies.
Yeah.
The businesses that just aren't built to withstand economic hardship.
So he's saying that surviving a recession actually kind of proves that a company is strong,
Yeah.
adaptable.
He points out that in the 2008, 2009 recession, a lot of younger companies, less established businesses, struggled.
Mm-hmm.
But the companies that came out stronger were usually the ones with solid foundations already in place.
Interesting. So was this guy like sitting on the sidelines during the 2008 recession, or was he actually, making moves?
He actually made some significant profits during that time.
Okay, color me interested. What was he doing to make money while everyone else was, losing their minds?
His core strategy is something he calls buying during the dip. Basically, he buys stocks when they're cheaper because most people are selling out of fear.
So instead of running away from the fire, he's running towards it.
Yeah, you could say that.
Bold move. Did he give any examples of companies he invested in during that recession?
He specifically mentions buying Bank of America and U.S. Trust.
Those are pretty big names, though. Not exactly like the risky startups you'd expect to go under in a downturn.
Right. And that's a key part of his approach. He focuses on companies with proven track records and strong financials.
Makes sense. Companies that are more likely to weather the storm, so to speak.
Exactly. But he also acknowledges that trying to, time the market perfectly and buy at the absolute bottom is nearly impossible.
Yeah, that's the holy grail of investing, right?
Yeah.
But almost no one can actually do it consistently. So what's his secret weapon? How does he actually put this buying the dip strategy into practice?
He uses something called dollar cost averaging. Have you heard of that before?
I've heard the term, but I'll admit I'm a little fuzzy on the specifics. Could you break it down for me?
Okay, so imagine you have $10,000 to invest.
Okay.
Instead of putting all of it in at once, you divide it into smaller chunks, like maybe $1,000 each month, and you invest it consistently over 10 months.
I see. So even if the market drops during those 10 months, you're still buying, basically averaging out your purchase price over time.
Precisely.
Smart. That's a much more disciplined approach than trying to be a market timing guru. So does this guy just buy any stock he can get his hands on during a recession? Or does he have specific targets in mind?
He's actually very selective. He believes that large, well-established retailers like Walmart and Target are particularly well-positioned during recessions.
Okay, yeah, I can see that. People might cut back on luxury items, but they still need to buy groceries, and those everyday essentials.
Exactly. He argues that as household budgets get tighter, people prioritize value and necessities, which benefits these big retailers.
Makes sense. So is he just waiting for the next recession to start buying up more Walmart and Target stock?
He's actually planning to increase his holdings in companies he already owns. And he's identified 33 companies he's particularly interested in buying more of.
Wow, 33 companies. This guy doesn't mess around. That sounds like he's done his homework. But what about companies he thinks might not do well during a recession? Any warnings there?
He specifically cautions against luxury goods and niche retailers.
Ah, okay.
He thinks that those companies which really rely heavily on discretionary spending will likely face challenges as people tighten their belts.
So he's predicting a shift from want to need spending during a recession. Interesting.
Exactly.
But wait, you mentioned 33 companies he's planning to buy more of?
Yes.
Does he have a separate list of companies he's hoping to buy for the first time when the recession hits?
He actually mentions having another list with 15 companies that he hopes to buy if their prices drop enough during a recession.
Wow, so this guy's got 48 companies on his radar. That's serious commitment. But I gotta ask, this whole buying during the dip thing, that takes guts. Most people I know, they're freaking out when the market tanks. How does this guy deal with the fear and uncertainty that comes with recessions?
Well, that's where the psychology of investing comes into play. And this is actually a fascinating part of his approach.
Hmm.
He believes most people make decisions based on emotions during recessions, driven by fear. And their gut reactions actually lead them to make bad choices.
Oh, yeah, for sure. I've definitely been there. Like when the market's crashing, it's hard not to panic and just sell everything.
Exactly. He even shares this story about a retired couple that he advised back in 2005, 2006. And he asked them, what would you do if the stock market fell by 50%?
Okay, so what did they say?
And the wife was really confident.
Okay.
She said they would buy more, understanding that it would be a great opportunity to get stocks at a discount.
Oh, that's like the textbook answer. Buy low, sell high, right.
Mm.
So did they actually follow through when the market crashed a couple years later?
That's the interesting part. When the 2008 crash actually happened, fear totally took over.
Mm-hmm.
They panicked, and they ended up selling a big portion of their portfolio, going against their original plan.
Oh, wow. So even though they knew what they should do, their emotions got the better of them in the moment. It's a good reminder that having a plan is one thing, but sticking to it during a time of crisis, that's a whole other ballgame.
Exactly, and he uses this story to highlight how fear can actually cause you to miss opportunities.
Right.
It's like this classic example of the gap between what we know we should do and how we actually behave when we face real-world challenges, especially when it comes to money.
It's like our brains know one thing, but our gut tells us to do the complete opposite.
Yeah.
So how do we bridge that gap? How do we train ourselves to be more like this expert who seems to actually thrive on market volatility?
Well, he emphasizes looking back at historical data to inform our decisions moving forward. He believes that studying past recessions can help us understand market patterns and then make more rational choices.
Makes sense. So what does history tell us about recessions and market recovery?
He specifically points to the 2008-2009 recession as this prime example. Let's say you invested $10,000 in the S&P 500 at its peak in 2007.
Okay.
Today, that investment would be worth around $14,500.
Not bad, right?
Yeah, 45% return over that time period is nothing to sneeze at.
But imagine if you had invested that same $10,000 at the very bottom of the market in March of 2009.
Oh.
Today, you'd have over $100,000.
Whoa, that's a huge difference. It really highlights the potential of buying when everyone else is selling, even if it feels scary in the moment.
He acknowledges that very few people can perfectly time the market and buy at the absolute bottom, but he emphasizes that even if you had bought the S&P 500 gradually as it was falling, using that dollar cost averaging strategy we talked about earlier, you still would have ended up with an average return of around 700% by today.
Okay, a 700% return is still an incredible outcome.
That really drives home the power of having a long-term perspective and staying disciplined even when the market's, having a meltdown. But what about those people who say this time it's different? Like, what if this next recession is so bad that it breaks all the historical patterns?
He actually points out a really important fact. Throughout the entire history of the United States, every single recession has eventually been followed by an economic recovery.
That's a reassuring thought. Even when things feel bleak, there's reason to be optimistic about the future. So this expert, he obviously has this very specific approach to investing during recessions. But he also mentions the importance of community. Can you tell me more about that aspect?
Absolutely. He talks about having a community of like-minded investors who share similar values and perspectives when it comes to navigating the ups and downs of the market.
I can definitely see the value in that. Investing can feel really isolating sometimes, especially when you're going against the grain and buying when everyone else is selling. It probably helps to have a group of people who understand what you're going through and can offer support and encouragement.
He believes that having a supportive community can give you a sense of belonging,
Yeah.
accountability, and shared learning.
Right. Right.
It can help you stay focused on your long-term goals and avoid making impulsive decisions based on fear or doubt.
It makes me think about those online forums and communities that have popped up around specific investing strategies. Like, I wonder if this expert is a part of any of those, or if he has his own community that he connects with.
Yeah.
It'd be interesting to know more about that. Perhaps he shares resources or recommendations in his full YouTube video. Speaking of resources, there's another interesting point he makes that I think is worth highlighting. He emphasizes that while this strategy, might sound pretty simple on the surface, it actually requires a certain level of, I guess you could say, mental fortitude. He even goes so far as to say that he wants you to be dancing when stocks are down.
That's a pretty striking image. I mean,
Yeah.
most people I know are running for the hills when the market takes a nosedive, not exactly breaking out their dancing shoes.
He argues that, look, everyone has the brain power to buy stocks, but not everyone has the stomach for it, right?
It's true.
He really believes that developing the right mindset is just as important as understanding the financial mechanics of investing.
So it's not just about knowing what to do, but also about having the emotional resilience to actually do it,
Exactly.
even when your gut is telling you to run in the opposite direction.
Yeah. And he believes that learning from experts, surrounding yourself with a supportive community, and studying historical data, all those things can help you build that emotional resilience.
It seems like he's saying that fear is probably the biggest obstacle to success in investing, especially during uncertain times like recessions.
Right. And he reminds us that bull markets, those periods of prolonged growth, they don't last forever.
Unfortunately not.
Eventually, there will be a correction, a pullback, a recession. And those who are prepared, those who have embraced a mindset of opportunity, they'll be the ones that benefit the most.
So as we're wrapping up this deep dive, I think one of the biggest takeaways here is this idea of shifting our mindset about recessions.
Right.
Could reframing our thinking, from fear and dread to a time of potential opportunity actually lead to better financial outcomes for us in the long run? It's definitely something to consider.
Absolutely. It's a thought-provoking question, and I encourage you to explore it further, especially, if you're intrigued by this expert's perspective. We highly recommend checking out his full YouTube video. If you want to dive deeper into this, we'll be sure to include the title in the show notes.
And remember, even if you don't agree with everything he says, it's always valuable to expose ourselves to different viewpoints and challenge our own assumptions.
Absolutely.
That's what the deep dive is all about. Thanks for joining us on this exploration, and until next time, stay curious.